Hello, welcome to the channel. My name is Jermaine Williams. I run a life insurance agency that covers all 50 states in the U.S. So my job is to train and mentor agents to have a successful career. So if you are an agent and you're looking for a new home, or maybe you're looking to get into the insurance industry, there will be a link in the bio so we can actually set up a consultation for you. On the other hand, let's say you're someone that's looking for life insurance for yourself or for your family, there's another link you can click so we can also set up a consultation for you as well. So today I'll be reacting to a video titled 4 Reasons Why Cash Value Life Insurance Sucks. So I'm type person, I don't run from the opposition. If somebody has something negative to say, I seek the heat. I'm going straight towards it when most people go against it because I understand there's different opinions, but I want to get to the root of it and see what is their concern and if it's really true or just something that they were misinformed on. So my goal is to make sure you're clear on whatever's going to be said in this video. So let's jump right in and check it out.
4 reasons cash value life insurance sucks. Number 1 is it's so expensive. I have $18 million of life insurance on myself. It costs me about $20K a year. That same amount in whole life would cost me $20,000 a month, not $20,000 a year. No.
Okay, so when it comes to life insurance, there's 2 different categories. There's term insurance and there's permanent insurance. So term insurance is going to last you 10 years, 20 years, 30 years, and that's it. It's pure insurance, so it's no cash value. There's nothing else involved. So historically, there's about 90 to 99% chance you will outlive that term. Meaning if you have a 20-year policy, there's a 99% chance you will outlive that 20 years, which essentially is good. But from a financial perspective, you've paid into that policy for all those years and you get nothing in return. Now, the insurance companies know these numbers, obviously. So when they're looking at it, they say, okay, well, I'm going to insure you for 30 years. There's a high chance that you will outlive this term. So if you outlive this term, the policy's over and we never have to pay out a death claim at all. So we don't have to charge you a lot of money because we know this insurance is only temporary. So because of that, as you make these monthly payments into this term insurance policy, that's pretty much all profit for the insurance carrier. So term insurance is extremely profitable because they're taking all these premium payments in and very unlikely that they have to pay out a death claim ever. So when it comes to life insurance, it's more like renting your insurance. You're only getting it for a temporary period of time. And I'm not saying term is bad at all. It's just that if you're looking at a price perspective, it's apples compared to oranges. Now, when it comes to permanent insurance, those typically go to age 120, 121, in some cases 131 years old. Right? So with the insurance company, they're looking at that like this very unlikely that you're going to live beyond 120 years. So they understand they will have to pay out a death claim to your family or your beneficiary one day. So they have to bake that into the cost. Otherwise, they'll end up going bankrupt. So they know they'll pay out a claim. So of course, it's not going to be as inexpensive as it would be if you got a term policy because the term is temporary, permanent is permanent. Death benefit will pay out. Another thing you have to take in consideration when you're looking at a permanent policy is that when you're making your premium payments, all of that money isn't going for the technical payment. It does have a component called cash value. And cash value is where you can put money in, it grows, earns compound interest. You could do a lot of things with it. But when you're making a payment, let's say I made a payment for, I don't know, $300 a month. That $300 is not paying for the insurance. The vast majority of that $300 is actually going to my cash value that I actually have access to. So that's even more of a reason why I say it's misleading to compare term insurance to permanent insurance when you're looking at cost or premium payments. So term would be more like renting the policy, where permanent is actually owning the policy. And based on your goals, that would determine which one makes the most sense. And in some situations, it's both. So now let's look at reason number 2.
Number 2 is that when you put money in, every dollar you put in for the first 3 to 5 years, they take. Imagine going to a bank and you opened a savings account in there and they said, hey, Mr. and Mrs. Client, we're so glad to have you. But just so you know, we won't plan on seeing you for 3 to 5 years because every dollar you put in here, we're going to take. Would you ever open that account if that's what they told you? Of course you wouldn't.
So what he's saying is that in the first 3 to 5 years of having your policy, all the payments that you put in, the insurance company keeps, and you get nothing going towards your cash value. So I say, let's actually look at a policy and see if that's actually true or not. Okay, here we have a policy illustration. So this person is a 35-year-old female. Death benefit is $101,000. But you can look underneath the blue bar where you see premium outlay. Premium outlay is the annual payment that went into that policy. So we can see $6,000 went into that policy in year 1. Accumulated value, that's going to give you a ballpark of how much money makes it towards your cash value that did not get absorbed in cost. meaning when you put the $6,000 in, you're paying for that $101,000 of death benefit, so that money is removed, and whatever's left over makes it to your cash value. So you can see in year one, you're finishing the year with $5,306. Then even on the cash surrender value, that's even $4,961, right? So we can clearly see year one, the vast majority of your payment automatically went towards your cash value. And the same thing happens for years 2 and 3 and obviously moving forward. So I would say what he said is absolutely false based on us looking at the numbers right now. And these are taken into consideration. The costs have been removed for the insurance, but even after that, you still have vast majority of your money going towards the cash value starting in year one. So I would say that's pretty straightforward. So now let's look at the next thing he has to say.
Secondly, after you start building up some money, you've got to borrow it out from yourself at interest payable to the insurer. Imagine you walked into a bank, you opened a checking account, and they said, man, we're so glad to have you as a client, but if you ever come back here for $1 of this money, we're going to charge you interest till you pay us back. You'd never open that account, would you? But you just did if you bought a whole life insurance.
Okay, so this is probably one of the biggest misconceptions when it comes to cash value life insurance. Now, when you access money, you have options. You don't have to take out a loan at all. You can take a withdrawal. So life insurance works off FIFO, first in, first out. So you can actually take out your cost basis, 100% tax-free, no harm, no foul. Now, you will have to pay tax on all the gains. So if you start pulling out gains, you will have to pay ordinary income tax, equivalent to if you were taking money out of a 401k plan, right? So, but you can withdraw from your cash value right out the gate. Most policies, it's 30 days or so. Now, the reason most people choose to do the loan option is because when you pull money out as a loan, you actually don't pay any tax on that growth. So, for instance, if you had $100,000 inside of your cash value, and let's say you wanted $70,000, you'd request a loan from the insurance company. The insurance company is the one that's actually giving you the money in the form of a loan. So because they're giving you the money in the form of a loan, you're going to have to pay back the insurance company. They're going to charge you interest rate. Let's say they're going to charge you a 3% interest rate. You're going to pay them back plus 3% on that interest rate. Why is that so significant? Because since the insurance company is the one that gave you the money in the form of a loan, that means your cash value technically was not touched. And why is that so important? That means the entire $100,000 is still parked exactly where it was, earning uninterrupted compound interest. Because people fail to understand that even though the insurance company is charging you a rate, they forget that your compound interest is still there, nonstop growing on the full amount regardless of the loan size. So that's what makes people so attracted to the policies, because they could take the $70,000 out, form of a loan. They could, invest it into whatever. Let's say they're investing into real estate, making a rate of return on that $70,000 and still know that $100,000 still tucked in their cash value, earning uninterrupted compound interest. So it could be at a fixed rate, or it could be following the market. So you can create a spread. You have opportunity to create a spread, because if they're charging you a 3, and let's say you're able to earn 8 from the performance of the market, you actually make a net 5%, right? Obviously that comes with more risk, because if the market performs at 0, you get 0. But if somebody follows the market, they understand the market's up more than it's down historically. So they may be okay with that. And you can switch back and forth between loan types every single policy year. You can say, I want a fixed loan where I'm gonna get a fixed charge and a fixed growth rate that usually are the same, 3% charge, 3% growth rate. Or you can say, I want an alternate loan where I'll take a 4% charge or 5% charge with the ability to grow following the market with whatever caps or participation rates that apply to the policy. So that's why people choose loans versus withdrawals. Another thing, if you take a withdrawal, you can't throw that money back in. But if you take a policy loan, you just created a hole. So let's say you need to take the money for 3 years. 3 years from now, maybe you've doubled it. You can dump that money back into the policy, no harm, no foul, right? So that's where people have that philosophy of being your own bank and things like that. But that's why people use policy loans over withdrawals. But withdrawals are available to you if you want them. So now let's move into concern number 4.
Number 4, way, way worse than any of those, is when you die, you get the choice of the insurance or the investment. You pay for both, but you only ever get one.
That's another thing that's absolutely false. So I'm going to bring back that illustration so we can look at it so I can show you the actual numbers. Okay, so here you can see at the top, the death benefit is $101,306. $328. That's the face amount. That's your original death benefit. Now, if you look down at the accumulated value, let's just look at year one, it's $5,306. But if you go 2 columns to the right where it says death benefit, you can see the death benefit is $106,634. Where did that number come from? That number is a combination of the original death benefit, 101, 328, plus the actual accumulated value. So if you look at every single year going down and look all the way to the right, you'll see that it is a combination of that initial death benefit plus whatever cash values in the account at that time. So it's not an either or, you actually can get both. So that was his last objection. So we went through all 4. Hopefully you have clarity and understanding, because I'm sure if he said it, he's not the only one that thinks that way. But now if you, as either the agent or you, the consumer, now have a clear understanding of how the policies work and some of the things that could be said about it that we're able to clear up in this video. So feel free to leave any questions in the comment section below. Follow for more content like this, and I will see you in the next video.